Sensitivity analysis for capital budgeting. How to assess risk in investment decisions by Garrett Sorley, 24th of February, 2025. In this topic, we're going to discuss what is sensitivity analysis, the variables in capital budgeting, accessible steps in sensitivity analysis, incorporating risk in capital budgeting, risk-adjusted discount rate, and scenario analysis. So to begin, we're going to talk about what is sensitivity analysis. Let's get a good general overview of what this is. So sensitivity analysis helps us understand how changes in certain variables impact a project's financial outcome. It's a way to assess risk and predict what could happen under different scenarios. For capital budgeting, it helps answer, how would my investment perform if certain things go wrong or right? So this technique is essential when you want to make sure you're ready for the unknowns. It shows what could happen if key variables change, like if cost rises or sales don't meet expectation. Sensitivity analysis helps you think through those uncertainties before jumping into an investment blindly. That takes us to variables in capital budgeting. There are four main variables in capital budgeting: initial investment, cash flow, discount rate, and project life. These are the four main players in capital budgeting. For example, a small change in cash flow can completely alter your net present value or your initial rate of return. The goal is to decide which of these variables matter the most and how sensitive the results are to those changes. Now that brings us to accessible steps in sensitivity analysis. Now there are 8 steps that we're going to go over for accessible steps in sensitivity analysis. The first one being identify key variables. You pick the key factor that will impact your project's performance. You set the range of the values, establish a range for each variable, like -10 or plus 10%, to test out different scenarios. Run the numbers. Use those ranges to calculate how each scenario affects your net profit value and your internal rate of return. Then analyze the impact. Look at how different changes affect your financial results. The idea here is to take the key factors in these 4 steps that you've identified to test and see if different scenarios, to see if they change the project's outcome. If you want to change cash flow by 10%, what happens to the overall profitability of the project? This gives you insight into what's the most critical to your investment. And now the next 4 is identify risk and assumptions. Think about what assumptions you're making about the project and what risk could change those assumptions. Look at dependencies. Are there any key variables closely linked? For example, do changes in market demand impact your sales and production cost? Consider different scenarios. Run a few scenarios, best case, worst case. Factor the external risk. Think about things like regulatory changes, economic shift, or competition that could affect your project. It's not about numbers. Sensitivity analysis requires us to consider external factors and the assumption that we're trying to making about the future. What happens if the market changes? What if the competition steps up? Thinking through these scenarios gives us a much clearer picture of your project's potential. Incorporating risk into capital budgeting. When you factor in risk, it's all about being honest with yourself about what could go wrong. We do the same thing with our personal stock market investments. You adjust your analysis to reflect that reality. For example, if your market is volatile, you might want to adjust the discounts rate or look at the worst case scenario to ensure that you're not blindsided. Incorporating risk in capital budgeting, such as risk-adjusted discount rate. For riskier projects, use a higher discount rate to reflect the added uncertainty. Scenario analysis. Run multiple scenarios, best case, worst case, most likely case, and see the different range of outcomes and see if it's worth that risk to your personal or your company's goals. Identify risk variables. Focus on which variables carry the most risk and have the biggest potential effect to your results. Risk-adjusted discount rate and scenario analysis. Now we're going to be talking about the risk-adjusted discount rate. We're recognizing that not all projects are equal. Some might face more uncertainty, such as fluctuating markets or technical changes. So increasing the discount rate to reflect that risk. For example, a startup with uncertain revenue would have a higher discount rate than a stable company with predictable cash flow. A key word right there, predictable cash flow. Scenario analysis is about testing multiple outcomes. It's one thing to see what happens in a most likely scenario, but when you want to know what happens if everything goes wrong or everything goes way better than expected, this way you're not making decisions based on one set of the assumption, but rather preparing for the range of possibilities. So with a risk-adjusted discount rate, you're going to adjust the discount rate to reflect your project's level of risk. Higher risk, a higher discount rate to account for that uncertainty. And in scenario analysis, explore different outcomes. They get the best case, the worst case, and the most likely case. Helps you prepare for the unexpected and evaluate the range of possibilities. So in conclusion, we talked about sensitivity analysis is all about understanding the uncertainties of your project and how they can impact your financials. Both the quantitative and qualitative steps are essential to get a full picture of the risk and reward. By incorporating risk, you make more informed decisions, reducing surprises down the road. And in the end, sensitivity analysis isn't just a tool. It's a way of thinking through the risk before making a big decision. Like I said earlier, we do the same thing when we're talking about, investing in a stock on the stock market. We look at the volatility. If is it high volatility, is it low volatility? Are we in it for the long run, or are we going to do day trading with it where there's short hits? It's the same thing on a much larger scale. It gives you the way to plan for the unexpected and make sure you're making the best choice even in uncertain conditions.